choosing what index to invest in can be pretty confusing. There are so many different kinds of indexes out there, and when people are trying to refer to the general stock market, they might be referring to different indexes, and there just is some kind of confusion about them. So today we are going to talk about three very popular stock market indexes that you might have heard of, but maybe you don't completely understand. And that's just fine, because we are going to discuss all three of them today and which one is going to be best representation for the overall stock market in the United States, and which one you should probably be investing in, at least in my opinion. And the three that we're going to talk about today are the S&P 500, the Dow Jones, and the NASDAQ. So you've probably heard of all three of those, because whenever you see any kind of financial news, you're probably going to see a little sticker at the very bottom that's running that has the numbers or the percentage of how those stock funds are doing. Okay, so all three of these are stock market indexes, which basically means they are tracking a certain part of the stock market. The first one that we should probably discuss is the S&P 500. So what is the S&P 500? Well, it's actually pretty simple to understand, because the S&P 500, which stands for Standard & Poor, is 500 of America's largest publicly traded companies, and they are measured by market capitalization. So what that means is that basically whatever the value of those companies are, that is what's going to determine whether or not they are part of the S&P 500. So companies that are in the S&P 500 are pretty much America's largest publicly traded companies, all 500 of them. In order to calculate their market capitalization, all you simply would do is you would take the price of their stock, so a price of one of their shares of each company, and you multiply it by how many shares are in that company. So for example, if you have a company with a share price of $10 per share, and the company has a total of 100,000 shares or of stock, then that company would be valued at a market cap rate of $1 million, because that is 10 times 100,000, and that equals $1 million. Of course, that's not actually a very large company. The actual companies that are on the S&P 500 are worth, potentially, multi-billions, maybe even $1 trillion, just depending on what they are priced at a certain day or whatever. So the S&P 500, let me actually throw it up on the screen for you really quick, just so you can see a list of companies that are currently on the S&P 500, because it's really important to know that the S&P 500 does change. Big companies, they will come and go, but the S&P 500 will always remain, because it is going to automatically adjust for those large companies, dropping off the S&P 500, and for those new companies that are coming on that are publicly traded. Most of those companies, didn't exist actually a few years ago, because many of them are, technology stocks and technology companies and things like that. So companies will come and go on the S&P 500, maybe not, very often, maybe not every single day, but they will come and go, and that index will adapt. It will always represent America's 500 publicly traded companies that are the largest, based on what the value of that company is. And within the index, those companies are represented as a percentage of their market share. So for example, if like a really large company like Google represents 2% of all of the US economy, then it is going to represent 2% of that market index within the S&P 500. When you actually buy a mutual fund or an index fund, these index funds, they are tracking that index, so they seek to mimic the S&P 500 by holding the same types of companies, or the same actual companies, and the same percentages, or at least as very close as they can be, to the actual index itself. And so when you invest in a S&P 500 index, you are trying to match exactly what that S&P 500 index represents within your mutual fund that you are investing in. The S&P 500 is probably the most well-known, and possibly even the most well-quoted among individual investors, but there are also these other market indexes that we do need to discuss. And the next one that you should probably know about is the Dow Jones. So the Dow Jones is another very popular market index that is always being talked about in financial news. And the Dow Jones is actually like the shortened version of it. The full name would be the Dow Jones Industrial Age, or informally known as the Dow 30. And that's because the Dow Jones represents 30 very large stocks that are traded on either the New York Stock Exchange or the NASDAQ Stock Exchange. And instead of being market capitalization weighted like the S&P 500, the Dow Jones is actually weighted based on price. So the price of the shares of each company is going to determine what percentage it represents within the Dow Jones market index. So it is a little bit different on how it's calculated and how the companies are represented within that index. And remember, we're only dealing with 30 companies this time. And the way that these companies are selected is also different than the S&P 500, because the S&P 500 kind of picks itself based on what is the most valuable company. Whereas the Dow Jones, these 30 companies are actually selected by a committee. So there is a committee of people who actually select these 30 stocks, and they might occasionally change it, or they might occasionally meet and just leave it the same, depending on, I guess, how the committee feels. There's probably a lot more that goes into, selecting the 30 that is done by that committee. But really, all you need to know is that the Dow Jones is 30 companies, and I'll go ahead and put them on a list on the screen right now, just so you can see a list of the current Dow Jones 30 companies. And of course, those companies also do change whenever the committee decides to change that list. And before we move on to that next index, I just want to say, if you are enjoying this video, please help me out and give it a like, give it a thumbs up if you're enjoying the video, and consider subscribing to the channel, because this is what On Cash Flow is all about. A lot about investing, a lot about saving money, a lot about achieving financial independence and becoming a master of your own cash flow. So if that sounds great to you, hit that subscribe button, and don't forget to put on the bell for notifications, because every single week, currently Tuesdays and Fridays at 8 a.m. Pacific Standard Time, I am putting out new videos, new information for you, and I know that there's just something that I can help you with. Now, moving on to the last index we are going to talk about, and that is the NASDAQ. The NASDAQ is a little bit funny because not only is it an index, but it's also a stock exchange. The NASDAQ is its own exchange, and it's also an index. And the NASDAQ actually stands for something really long. Let me actually read it directly so I don't mess it up. It is the National Association of Securities Dealers Automated Quotations Exchange. So that is the exchange. And also you have the NASDAQ Composite, which is the index. And the NASDAQ index, what that actually represents is all of the securities that trade on the NASDAQ stock exchange. Within that index, they are market capitalization weighted, just like the S&P 500 is. So whatever the company represents, which is its share price times its number of shares, and that equals the value of the company, the larger the value of the company, the more of a percentage, the more representation it is going to get within that NASDAQ index. And what's unique about the NASDAQ index is that they are mostly technology related stocks, but not all of them are. But mostly it's known to be mostly technological stocks. Now here comes the biggest question, and probably the most important question that you want to know. And that is, which one of these indexes should you invest in? Which is a better index? Which one best represents the overall stock market within the United States? And that is definitely not an easy answer. There are many other different stock market indexes within the United States, and these three are probably just the most well known. If I myself had to pick between these three stock market indexes and say which one mostly represents the entire US economy, I would pick the S&P 500 just because it is market cap weighted. So the value of the company represents more of the index. And these S&P 500 companies, these 500 companies are so large that generally they represent at least like 75% of the entire US economy. So I think that they're pretty darn close to representing the state of the US economy, because they are so large and they represent so much of the entire economy, like so much capitalization of the entire US economy when it comes to the stock market. But there's even one thing that can be taken further, that can be a better representation that we didn't talk about, and that is just a total US stock market index. Because what that total stock market index does is not only does it take the S&P 500, that 75%, but it also adds in all those other, medium companies and smaller companies to try to get it closer to 100% of the entire US stock market. And by doing so, if you were to choose to invest in a total stock market index, as I like to do, then you would be exposing yourself to more of those smaller companies and potentially more return. But also with that comes a little bit more volatility, because smaller and medium cap companies usually do have more fluctuations in their value. Those companies will come and go a lot quicker than these very, very large companies that are only represented in the S&P 500. But still, a total stock market index will be market cap weighted, which means they still contain 75 to 80% of the S&P 500 within that index. And then that other 20% is going to be represented by those smaller companies, again, depending on the value of that company. and that is going to determine how much it is represented. There are many different total stock market index funds. Just to name a few, we have the Vanguard US Total Stock Market Index, we have the Dow Jones US Total Stock Market Index, the Wilshire 5000, and the Russell 3000. So those are a few total stock market indexes that you could choose to invest in. I started off with Fidelity Investments, and so their total stock market index fund tracks the Dow Jones US Total Stock Market Index. If you invest in Vanguard and you invest in one of their total stock market indexes, then probably you're going to be investing in the CRSP US Total Stock Market Index. They're mostly all the same. They're a pretty good close reflection of the total US stock market, and they're certainly very easy to invest in for an individual investor. I don't particularly invest directly in the S&P 500, the Dow Jones, or the NASDAQ, just one of those indexes. I choose to do the total stock market index just so I am very well diversified, and it keeps things very simple. And that is one of the biggest things that I think helps out individual investors, is to invest in something that is easy to understand and that can easily diversify your investments, and it has a low amount of fees. If you want to keep learning more about investing, about growing your net worth, about becoming a master of your own cash flow, then make sure that you like this video and subscribe to the channel, but also you watch this video right here if you haven't already. It is a full guide that I made on how to achieve financial independence and how to become better at managing your own personal cash flow. So watch that video if you haven't already. Thank you so much for watching this one. My name is Zach from OnCashflow.com, and I hope to see you next time.